Welcome to the financial world where numbers tell untold stories. Today we're exploring the giant beverage maker Coca-Cola. Is it a good buy right now? Stick around to find out. Coca-Cola, a name synonymous with refreshment and a global market player with an undeniable influence. However, a recent article from Seeking Alpha offers a more nuanced perspective. It suggests a neutral stance on Coca-Cola's current valuation, indicating that while the company is a strong player, it may not be the best time to invest in it. This perspective is largely influenced by rising interest rates, which have been a drag on the stock. But it's not all gloom and doom. The same article also highlights that if the price of Coca-Cola dips before the start of the new year, it might be a good time to buy shares. So, Coca-Cola is in a bit of a limbo, but is this the whole story? Let's delve deeper. Coca-Cola's financial performance is a key determinant of its investment potential. So let's break down the numbers. At the heart of any investment decision are the hard figures, the financial metrics that provide a snapshot of a company's health. For Coca-Cola, a key figure to consider is the price-to-earnings ratio, or PE ratio. This key statistic is a measure of a company's market value relative to its earnings and can be a useful tool for comparing the relative value of different companies. In recent times, Coca-Cola's PE ratio has become more appealing, indicating that the company's market value is falling relative to its earnings. This is a positive sign for potential investors as it suggests that the company's stock is becoming more affordable. Next, let's consider the company's price to sales, cash flow, and book value. These metrics also provide valuable insight into the company's financial performance. Recently, Coca-Cola's stock dipped below $45, which has implications for these metrics. The lower price means that the price to sales, cash flow, and book value ratios have all fallen, making the company's stock more attractive from a valuation perspective. Now let's compare Coca-Cola's financial performance with that of its main competitor, Pepsi. When we look at the numbers, it's clear that Coca-Cola is performing strongly. The company has higher margins than Pepsi, indicating that it is more profitable. It also has a better free cash flow yield, which measures how much cash a company generates relative to its stock price. This suggests that Coca-Cola is more efficient at generating cash. In addition, Coca-Cola has a higher earnings yield, which measures a company's earnings relative to its stock price. This indicates that Coca-Cola is more profitable relative to its market value. Finally, Coca-Cola has a higher dividend yield, which means that it returns more money to its shareholders in the form of dividends. Clearly, Coca-Cola is financially strong, but the question remains, is it a good buy right now? Investing is not just about numbers, it's about understanding the business and its moat. So, what's Coca-Cola's competitive advantage? Well, let's start with the obvious. Coca-Cola's brand strength is indisputable. It's one of the most recognized and admired brands globally, with its logo and products known in every corner of the world. This strength has been built over many decades and is not something that can be easily replicated by competitors. The Coca-Cola name carries weight and trust, prompting consumers to choose it over other beverages. But that's not all. Coca-Cola's global presence is another significant advantage. The company operates in more than 200 countries, making it a truly international player. This vast reach allows Coca-Cola to generate stable revenues across different markets, reducing its dependence on any one region. Let's not forget the distribution network. Coca-Cola's products are available everywhere, from large supermarkets to small corner stores. This extensive network ensures that wherever a potential customer might be, a Coca-Cola product isn't far off. Now, let's transition into Coca-Cola's dividend history. The company has been paying dividends consistently for over 100 years, making it a dividend aristocrat. This means that Coca-Cola has not only paid but also increased its dividend payout for at least 25 consecutive years. For income investors, this consistency is a beacon of reliability, offering a steady stream of income even during economic downturns. Moreover, Coca-Cola's dividend yield has consistently outperformed that of Pepsi, its main competitor. This higher yield, combined with the company's strong cash flow, makes Coca-Cola an attractive option for those seeking a steady income from their investments. A strong business moat and a consistent dividend history make Coca-Cola an attractive investment. But is it the right time to buy? We've dissected Coca-Cola's financial performance, understood its business moat, and looked into its dividend history. Now, the million-dollar question, is it a good buy right now? Let's circle back to the key points we've discussed. The financial performance of Coca-Cola has been robust, even during the peak of the pandemic. Its business moat, fortified by its global brand recognition and extensive distribution network, is undeniably strong. Its consistent dividend history also speaks volumes about its profitability and stability. However, rising interest rates and the stock's valuation have been a drag, suggesting that buying at the current price may not be the best move. If the price dips below $45 before the year ends, it could be a more appealing proposition. When compared to its rival Pepsi, Coca-Cola shows higher margins, better free cash flow yield, higher earnings yield, and a higher dividend yield, making its investment proposition more attractive. So is Coca-Cola a good buy right now? The answer hinges on the price movement. If it dips as predicted, it could be a worthwhile addition to your portfolio. But at the current price, it might be wise to hold off and wait for a more opportune moment. Remember, investing is a marathon, not a sprint. Always do your own research and make informed decisions. And don't forget to subscribe and comment. Until next time, keep investing smartly.